Hey guys, we are here today at RealPage event and we are here to listen to Sean Hildebrand, who has one of the best insights when it comes to market knowledge. So let's check it out together.
It was interesting. As we kind of closed out 2024, it looked like the market was on a recovery path, right? We saw some really solid growth numbers in the fourth quarter. Sales were up more than 20% year over year. Prices were starting to trade higher again. The market was comfortably balanced. So Chris and I have been working on this for over a year now. We're not quite ready to present all of the results, but one thing that we've been talking about is when you take away all the headlines, all the noise around the market, fundamentally, what are the 7 factors that drive housing values in the GTA? Obviously, fundamentally, population growth, the economy, homeownership affordability, which has been key. Interest rates obviously have been a huge factor for the market over the last several years. Investor activity, right? When investors are active, it helps to swing the market up. When they take a step back, as we'll talk about in the condo market, it tends to dramatically slow down sales activity and also supply. The replacement cost, like what's the cost to build? Does that factor into what the fundamental value of housing is? Housing supply as well. How many homes are being built right now? How many deliveries can we expect in the years to come? And I think one of the most important things right now is consumer confidence, right? Consumer confidence is key right now in today's marketplace. I understand that the last several years have been very challenging. From an analyst perspective, it's been very enriching, right? We get to understand more and more about how this market works. And interestingly, with sales at multi-decade lows, inventory levels at record highs, housing prices in the GTA are still pretty stable, right? If you plugged in these numbers into an economic model, it would forecast that housing prices would have dropped by 25 or 30%. But they haven't. We saw an initial correction, obviously, when interest rates jacked up very quickly. Since then, basically flat for about 3 years now. Very interesting. And this speaks to the fundamentals of this marketplace. Now, speaking of consumer confidence, I haven't looked at this indicator in a long time because it hasn't really been that big of a factor. But right now, and it's huge. The Conference Board of Canada puts out a consumer confidence index every month. And they ask Canadians how they're feeling about their financial position. Is it a good time to make a big purchase? What do they feel about their employment prospects in the months ahead? And the data is showing that consumer confidence in Canada is at a historic low. It's even worse than what it was during the initial months of COVID and during the global financial crisis. Now, this is because of amplified concern about what's going to happen as a result of the trade war, particularly in markets that are heavily reliant on U.S. trade, particularly those in southwestern Ontario, parts of Quebec and Alberta. There's obviously been a big whipsaw in financial markets. Interest rates have come down, but they're still higher than where they were years ago, right? Mortgages are coming due at higher rates. Household budgets are strained. Household debt is still near record highs. Consumers are feeling a strain on that. And nearly 70% of all consumers right now think it's a bad time to make a major purchase. With all of this uncertainty in the market, there's a lot of just waiting and seeing. And the biggest ticket purchase you can make effectively is a home. And we've seen what the implications have been on the housing market. Now, the Bank of Canada is doing their best, right? They have no idea how this is going to unfold. I don't even think Trump knows how this is going to unfold, to be honest with you. But effectively, if you take his word as given, the tariffs that were announced on April 2nd would effectively put tariffs at their highest level in more than 100 years. Now, a number of different scenarios can shake out, right? It seems like the changes applying every day. But the Bank of Canada has put forward a couple of different scenarios. In scenario 1, most of the announced tariffs are negotiated away. There's still going to be some tariffs, which I think we're all understanding that this is going to happen. It's a reality. But the uncertainty around tariffs is going to persist. It's going to persist for the next couple of years. Under scenario 2, however, further U.S. tariffs beyond what was announced on April 2nd, a long-lasting trade war unfolds, and the economy enters into a severe and deep economic recession. So how does the Bank of Canada model this in terms of projecting inflation, economic growth, and how do they choose what to do with interest rates? We know that inflation is well under control, 2.3%. However, it has picked up a little bit recently, right? We were trending at or just below 2%. And now with the depreciating Canadian dollar, which makes imports more expensive as well, businesses have been said to be proactively raising prices in anticipation of higher costs coming from tariffs. That's adding to inflation as well. So the Bank of Canada has the decision to make. Do they lower interest rates to help insulate the economy, or they hold steady, thinking that obviously with higher tariffs, there's going to be higher inflation and a need perhaps for raising interest rates, potentially at some point in the future. Under scenario one, economic growth weakens temporarily. So this is a scenario with some tariffs, but not necessarily what Trump's been announcing. Under this scenario, the economy slows down, inflation falls to 1.5% for about a year, and then it returns to the 2% mark. Under this scenario, the Bank of Canada will cut interest rates. They will continue to cut interest rates. Knowing that this is a temporary situation, they need to support the economy, they will continue to cut. Under scenario two, they'll probably cut as well, but they have to take into consideration that with higher tariffs, inflation will rise above 3%. So in the April 16th announcement, they held the Bank of Canada's policy rate steady at 2.75%. Obviously, it's come down a lot from where it was when they began this interest rate easing cycle. It was 5%. A neutral rate is judged to be around 2.5%. So a neutral rate is a neutral rate that doesn't stimulate or impede economic growth. So the outlook for the economy is obviously very uncertain at this point. We've seen that the unemployment rate has been moving higher. Part of that is just due to the sheer volume of people that have moved into the country in the last couple of years, right? And more people looking for work. The job market has a real tough job to do in keeping up with that level of population growth. The cities that are most exposed are energy dependent, obviously, Calgary, but also a number of communities in southwestern Ontario. Toronto actually ranks fairly low. We don't have a lot of direct exposure to U.S. trade. Now, we have a lot of indirect exposure, right, through financial markets, the services sector, but we don't have a large goods producing sector that directly trades with the U.S. We're mostly a services providing sector here in Toronto. So the direct impact on Toronto is not as large as what you would see in Waterloo, Brantford, Guelph, and certainly Hamilton. One thing that's been driving activity higher, or certainly insulating the economy within Toronto, is just how many people have moved in to the GTA over the last couple of years. In the 2-year period of 2024, we've had over 450,000 people move into the GTA. That's like adding another Hamilton into the GTA in a 2-year period. It's a massive amount of population growth. One thing, however, that's going to slow down population growth in the next few years is new government policies that are targeting a lower number of temporary residents. Okay, as you can see from the chart here at the left, non-permanent residents have represented the majority of population growth in the GTA over the last couple of years. Right, we've heard all the stories about international students flooding into certain markets, bidding up rents, causing undersupply of housing, capacity strains and pressures on the healthcare system, education system. Active listings for detached properties, semi-urban in town, record highest level since 2009. Active listings continue to grow 50% year over year, 48% year over year, and they are at a record high. So while active listings for low-rise are at their highest level since 2009, condo apartment active listings are in fact at a record high. And when you look at the monthly supply, it tells a similar story, right? Active condo listings right now are equal to more than 6 months of supply. Again, a balance level is around 3 to 4. The only segment of the housing market right now that is in balanced market territory are semis, roads, and towers. Okay, they're at 3.4 months of supply. Detached has moved slightly above 4 months. Condos at 6.2. If you look at small units that are under 500 square feet, more than 10 months of supply in the marketplace right now. Are an important segment of the GTHA housing market. I think it's a gross understatement. And to suggest that they aren't an important part of the rental market is even more of an understatement. About 50% of all condos are used as rental properties. We've barely built any purpose-built rental units, right? About 30,000 units in the last 10 years. In fact, if you look at all the condos that have been added into the rental market the last 10 years, they've represented 80% of total rental supply increase that period. Okay. So if you aren't building condos, you aren't building much of anything, but we certainly aren't building rentals, right? We can rely on individual condo investors to drive this market and add rental supply. Now that they aren't active in the marketplace, we're seeing construction starts plummet. In a few years, this is going to translate into the lowest number of condo completions that we've seen in decades. The housing supply in the condo segment is going to effectively stagnate. Why? People aren't buying new condos anymore. New condo sales in 2024 were at their lowest level since 1996. We know this. We've been tracking the market since the 80s. Sales were down 64% from 2023, which was already a weak year. They were down 78% from the 10-year average, 85% from the record high, 2021. If you look at the long-term trend, we've been selling 20 to 25,000 pre-construction condos every year. That's helping to fuel deliveries of around 20,000 units every year, right? More than half of all housing supply. It all starts with new condos. So it all starts at the pre-construction stage. We recently released our Q1 stats, which showed that the trend is actually continuing to decline, if you can consider that. After what we saw in 2024, things got even worse in the first few months of 2025. Developers aren't doing anything. Buyers are buying. We had around 500 new condo sales in the first quarter. It was the weakest Q1 going back all the way to 1995. The condo market was effectively down 95% from its peak in the early part of 2022. Construction costs are up 89%. New condo prices, while up considerably from where they were in 2017 at 52%, nowhere near the cost inflation that developers have experienced. This makes it extremely difficult for them to lower prices. Now, we've heard just recently that the city of Toronto is freezing their development charges. That's great. It's not going to help, right? We need significant relief. We need development charges to be removed, which is what some municipalities are doing, right? Some forward-thinking municipalities like Mississauga and Bola have effectively wiped out development charges for a period of time or significantly reduced them. As a result, developers are sitting on record levels of unsold inventory. 23,900 units. Most of those units are in the pre-construction stage and the under-construction stage. We'll equally split between that. We have some inventory at the complete stage, which we'll talk about. Hopefully, at some point this year, we can get a little bit more clarity and some improvement in consumer confidence around what's happening with the U.S. and hopefully avoid any sort of steep negative economic repercussions. I think we'll probably see a little bit more deflation in price. Prices have proven to be resilient. Everything that's been happening, as I said, prices basically haven't moved in 40 years. What's going to be the catalyst to make them move even lower? Obviously, we have more supply in the market, sales are low. We should see a little bit more deflation, but there's nothing out there right now that suggests to me that we're going to see any sort of big correction in the marketplace. I think interest rates are probably near their bottom. So, if you're thinking about getting in the market, maybe you're waiting for a little bit more favorable conditions in terms of price later this year. Interest rates moving a little bit lower, but we're pretty much at that point. The condo market is going to remain challenged this year, probably next year as well. It's going to take some time to unwind all of that excess inventory. But as completions move lower, a new cycle will restart. Okay? The condo market operates always 4 to 5 year cycles. That's how long it takes to pre-sell a unit and ultimately deliver it. So we've seen these 5-year cycles happen consistently over the last 25 years. We're in that 5-year cycle right now. The peak of the market was early 2022. 5 years from then, the bottom of the market will probably be late 2026 through to 2027. Okay? Things will get better, right? As they say, the night is always darkest before the dawn. And I think that's kind of where we are right now, right? The numbers don't look great, but fundamentally, the GTA market has proven to be extremely resilient, and the medium to long-term outlook is still very positive. Thank you very much. If you have questions, I'll be happy to take them.